So recording has commenced. Everyone please mute their microphones so we don't have any background noise. This is Clueless 8 Trading. Frank, thank you for joining the free market webinar, which I intend to do at least once or twice a week instead of just doing the end of the day reports and things like that. I think this is more interactive, gives people to engage, and more productive. They will normally be held around this time, anytime between 7 and 9 p.m. Eastern Standard Time, and they will be obviously announced on the Twitter feed and the other mediums that I use. Full disclosure, this is purely for educational purposes and not for any financial solicitation or advice. The session will be recorded and uploaded on the Clueless 8 YouTube channel, and and I encourage everyone to subscribe, which obviously is free. Just click on subscribe on the Clueless 8 Trading YouTube channel, so that at any given time I put things up there, then you'll be automatically notified. Very important that everyone does that, and you can tell your friends to do it too, even if they're not members, because the free stuff, the free video casts and these type of webinar updates that go up there, it's open for anyone to review and hopefully benefit from. So it's a great educational tool, and I believe it's a constructive marketing tool, given the fact that my service, Clueless 8 Trading, is purely organic. We get people primarily through referrals. I like to keep it that way, and we don't go around advertising in all different forums with banner ads and stuff like that many do, because I'd like to basically keep this to a certain degree a little bit more exclusive than many other services that's out there. Okay, let's start off tonight by taking a good look at the S&P 500, the E-minis. But before I start with the technicals, let's just talk about a couple of observational behavioral stuff that I always talk about. As you know, that's part of one of the key main features of my service. And it's fundamentally different than probably some of the other services which purely talk about, the lines and the numbers and stuff like that. So what have we learned over the last couple of days or over the past week? That there is massive risk in both the long side and the short side. Got a taste of that today. The portion of the portfolio that was on the short side, which was looking fantastic till about 10:30 a.m., just almost blew up. Doesn't mean that you're not going to get your money back tomorrow or over the next 48 hours, as we will inevitably have a quick retracement and a reset, as I like to call it. But for the day, on the short side of things, it was a complete disaster. Regardless of the regardless of the technicals, which showed that we were going to go test S&P 2020 and all kinds of good stuff, it just turned around and just exploded higher. And right at this point, where we think that everything's just peachy and we're just going to get a one-way run all the way up to 2080, which looks like we will inevitably get to, in my opinion, we might quickly get a sweet correction, which late buyers or sort of the late longs, on if they kept all their profits still running on their books instead of cashing them in, or at least taking a good portion or a partial profits like I always do, all of you know that, might get ambushed. Now the rewards on the long side are equally the same. A day ago, it looks like everything was going to hell in a handbasket. And that is the nature of volatility. Now people, I talk to a lot of people, I make a point of talking to every one of my members and a quick conversation with anyone who comes into the service as a free trial subscriber before the join. And one of the things that I tell them is that quantifying volatility is almost impossible, because the nature of volatility is volatile. But what I try to do consistently is try to put a measure of probability whether you're going to win in that trade or not win in that trade through my technical expertise, through my gut instincts, through my behavioral game theory modeling, through information processing that comes along the way, as in breaking news analysis, my interpretation of what large economic numbers might mean, the central bank speak that I try to dissect as much as possible, and so far pretty accurately have done that. So it's not always the layer of news that comes out, it's what's behind it. But even then, you have days like today, where at least on the short portion of the portfolio, it's a total loss, at least for today. So the thing that we have to appreciate about these markets are, and I've talked about this extensively, is these are truly mechanical, machine-driven markets. There is truly no fundamental basis, good or bad, for things to move up and down to the degree that they're moving in. Even if we, when we look back at this particular market, let's say from last, as you can see here, from last July till now, from the highs of 2134. That was, back in July. It was actually back in May, but pretty much at the same level. S&P 500. You can see that on the left-hand corner of the screen. And all these huge crashes, straight down, flash crashes, sovereign fund, wealth funds blowing up, high yield bond defaults, CDS default rates, the default rates exploding higher, i.e. risk just exploding. And through all this, it seems like a beautiful pattern. But as humans, we have to realize one thing. It doesn't matter how good we are in what we do. There will be instances where even our best expertise, and I certainly do a fine job of pinpointing major inflection points and showing the probability of what something might happen, such as this consolidation flag, which I talked about endlessly over the last couple of days, that this was just a consolidation flag. And there was a good possibility that we would break out. And that's exactly what we did today. Regardless of that, reading and microanalyzing whether or not it's going to come down to 2022 or whether it's going to break out to 2061 is almost an impossibility. But when we look back at the picture, in hindsight, it all seems so manageable. The bad news is that it's not. Because you don't know when you get these massive double bottom moves here that we're going to move like this and that we're going to move like this in a symmetrical fashion that has occurred over the past 12 months. So what we try to do is try to catch the meat in the middle and take profits as the market rises. Now, in order to do that, and that's the reason why I keep on emphasizing that for a few dollars that everyone enroll in the advanced coaching sessions. And we're just going to touch the basics on it here. We don't have time to go through the internal details that much. That there are indicators and certain things that you can see which tell you whether or not the uptrend is still intact or whether or not we are going to be on a one-way train down. And some of you have heard this many times, but it's good to remind ourselves what those major indicators are that we can take a look at any chart and get a reasonably good understanding whether or not it's going to be breaking down or whether it's going to be breaking up. Now, saying all that, what happens over an 8-hour basis in the market is not quantifiable. In other words, unless you're using some very specialized charts such as the ones that I use, and I have always told people that if they'd like to subscribe to it and try it out, those are the Algo HFT, algorithmic high frequency trading charts that are provided by a company, very specialized company that actually their biggest customers are investment banks on Wall Street and many hedge funds, company called Quad. Then those are the ones which really show you that kind of blow by blow type of movements. And even then, when the machines go to work and they're pumping, they're doing the liquidity pump and the liquidity drain, i.e. the candles keep on going green and red over a matter of minutes, even then it gets tricky. So let's get into, so that's something we have to take into account. The other thing that we have to take into account is that we have to adapt. And if somebody doesn't switch sides and adapt within the means that they have within their account, then unfortunately they won't be able to survive this market. Because I'll tell you one thing, that this market is not it's not your grandpa's market. Like I've said this many times. So anyone who's trying to make this market to be a simple oh, we're going to keep on going up, we're going to keep on going down, and you all know how many times we hear comments in our room, and not to mention other forums, where it's just like, oh God, everything's over, and then, oh God, look at this, now we're going higher. The fact remains that the volatility is here to stay. So let's take a look at this here. All right, let's take a look to see what I think is going to happen. First of all, one of the key points of key inflection points is right here, and you can all see that. This was the point of maximum failure back at the end of December, after we had that mini Santa rally, this one. Okay, and if you notice, it was again another dragon bullish formation within a downward sloping channel. This was a channel. All these lines are drawn by me, and that's part of my job to do, is to put a structure behind all these red and green candles so that you guys can make sense of where we stand within the realm of where we are. In other words, where are we positioned within the market? So here was another mini dragon bullish formation, multiple actually, you can see that. And then we gave in. And that break came at the beginning of January, right there. We just, we just collapsed. Now, if you look at this pattern here, and pattern recognition is key. However, the pattern recognition part in many cases is highly reliant on cognitive bias, behavioral game theory. What does it mean? We see the world through our own eyes. We see the world through our own experiences. Any major psychologist will tell you that. We tend to judge things based on what we have gone through and what we have, what we feel might happen. Therein lies the whole concept behind bulls and bears. Some people are highly negative about the world, about the U.S. economy, what's going on, central banks, all that. And some people are just too gung-ho about it. I try every single day, and I'm sure all of you do too, to keep a balance between the negativity and the positivity that emanates out of the market every single day. If you are a perma bear or if you're a perma bull, then it doesn't make any sense. Yes, you'll win over short terms. When the market's rising like this, being a perma bull counts. But then what happens? You could have a massive reversal, okay, of these levels, which we will talk about in a second. And then do you still remain a perma bull, or you become a perma bear? You become a, like I like to say, dogmatic bears. Oh, the world's coming to an end, and this is it. This is the top. This is it. It doesn't work. You get days like today where the market literally decimated billions of dollars. And I mean it, billions of dollars worth of short hedge funds who scrambled for cover. This one candle alone, in my opinion, was probably $8 to $10 billion, if not more, of short covering and pain. So this didn't happen because all of a sudden new buyers surfaced. It happened because a large number of heavy-duty, primarily hedge funds who are short the market just scramble for cover. It's almost like a Pearl Harbor type of bombing. The algos, the institutional fund managers, and the powers that be, which actually control the bigger money. Keep in mind the $3 trillion hedge fund industry is minuscule compared to, I think, somewhere like 20 trillion or something. I don't have the exact number worth of the mutual fund complex and things like that. Okay, pension funds and everything included. So they got blasted, ambushed. So let's see what I think might happen. Right now, futures are up about 3 points. And we can see, I'm going to put the E-minis here in a second so we can see real time what's going on. But let's take a quick look at this pattern, So, oh, sorry, I lost my thought for a minute. So the cognitive bias part of it, whether we're bearish or bullish, skews our realistic assessment of patterns. Somebody can be looking at this rising diagonal, pennant, whatever, I mean, the rising diagonal, this I call it a rising wedge, keep it simple. I saw this consolidation channel, and all of you, and it shouldn't be some of you, but all of you who review my charts saw me write consolidation channel right here on this arrow, and that's exactly what played out today. So this consolidation channel right now is breaking out. This is also known as a bull flag. I used to call in the old days, as a joke back in on StockTwits back in 2011, 2012. I used to call it the galloping horse because it kind of looks like a horse's head right there, the horse's neck and the head. So right now, just simple stuff. 2080 is where it's, where the major resistance comes in. And that's where we're going. So we got 20 more points here on the S&P, which I think gets delivered to us by Friday. Now, what's 20 more points? Multiplied by 6 or 7, and each S&P point is roughly 6 or 7 Dow points. So you're talking about another 120 to 140 Dow points that we can capture to fill this gap towards 2080. Now, what happens at 2080? All of a sudden, we just crash and burn like we did back in January, late December? Maybe not. I think the way they want to get things going, and now that oil has become supportive, thanks to it's not a rumor, it seems quite certain that the Saudis and the Russians are going to, hammer heads. And keep in mind, from a political standpoint, the Saudis and Russians are not friends. Now, I don't get into it too much, but the Saudis support the rebels in Syria, if you want to look at the Middle Eastern conflict, and the Russians are putting their Sukhoi, whatever they call it, bombers and their people to support the regime in Syria. So they're in loggerheads on the political front in many ways. The Russians are pro-Iranian, the Saudis hate the Iranians. But when it comes to oil, they're the two of the largest oil producers in the world. So if they say that they're going to freeze output, then the oil prices are going to go higher. I'm going to show you the oil chart too. We can easily go to $50. Now, saying all that, once we hit 2080, it's not like it's an automatic sell trigger. Yes, there's going to be some turbulence at that point because it will be profit taking. But my opinion is that if you just look at it purely from a technical basis, then the tip of this rising wedge right here, which is somewhere around 21, not 2120 necessarily, but 2110, which is roughly, what is it, 40, 10, 50 S&P points from here. That's roughly 350 or 360 Dow points, which brings us to where? It brings us back to Dow 18,000 plus. So right here is Dow 18,000 plus. My opinion is they want to print that number by the end of April, which is not too far away. Now, is it going to be a straight line up? I don't think so. I think there's going to be a pullback, minor pullback, and that's what we're going to talk about right now. Want to remind everyone very simply, forecasting is not easy business, okay? Doesn't matter what patterns I show and all kinds of technical. I look at the simple stochastic fast indicators, which actually serves me very well. And I keep on pushing onto people, hammering them that they should be doing the same thing on the platforms that they use. Hopefully they use some platforms which matches the charts that I print on. I use Thinkorswim. I use the proprietary platform, the Algo HFT one, bar charts primarily, and then I use freestockcharts.com. I use TradingView. So at least the one of your platforms should match the ones that I use, and primarily it should be Thinkorswim. So at this point, the market has momentum on its side, and you can't fight momentum. Momentum is just pure momentum. A body at motion stays at motion. Doesn't matter what things are out there. Wants to get there, it'll get there. So this is where the market wants to go, 2080. Does it go there immediately tomorrow? I don't know. All I know is it gets there by the end of the week, because this consolidation flag has now broken out. Once it gets there, if you want perfect pattern symmetry, let me draw this out for you. This is the final destination, I believe, around 2100. So if that's the case, why, you can go like this. Maybe the market pulls back a little bit and then goes higher. Now, why do I bring it down here? Because this is a very strong level of support, which is around the 2000 to 2020 level. And if this is the pattern that's going to replicate on this side, then that 2020 level, which I was expecting today, it's not my fault that they decided to release the so-called agreement between the Saudis and Iranians. And keep in mind, it hasn't been confirmed yet, because the last thing was that the Kremlin announced, the Russian parliament, the Kremlin, announced that there is still hope that this Doha meeting on Sunday produces that result. They didn't say it's a done deal. So what if they don't? Or what if this happens? This is how you think outside the box. What if they say, yes, we will cut output, but it's a lot less than what the market is thinking? Then you're going to see that big fat correction that you can expect, and oil could drop $2-3, and then the market accordingly will fall 300-400 points. So that could be this part. This could be that pullback that we didn't get today. Now, what did I expect today? Just so you understand what goes on through my head. And of course, it's not going through my head. I show this constantly. I expected, which would be absolutely perfect, that we retest the bottom end of the consolidation channel right at this level. I was positioned for that through my S&P puts. Not to mention I had my longs running. I was taking off some profits, but I get my longs running. The Googles, the cheapo, the lottos, they were not really lottos, but they were cheap. For price line, a $4 call is a lotto, because it's so expensive to buy those calls. But if you remember, I bought them last week, the 1280s and all that stuff, and they were just going berserk. Well, they went really berserk after the reversal, obviously. So because I didn't know that was going to happen, or else I'd have bought a ton of them right at the lows when the market was pulling back today. So the so-called real perfect scenario would have been, and the market is certainly not perfect, and you know why? Because the hunter-killer algos, as I like to call them, are always looking for clusters of stops, clusters of calls and puts wherever they are, and then attack them. Okay, so it's not any sort of exclusive news or that no one knows about, but there's a huge amount of shorts in the market. All right, and I posted some very detailed articles on that. I mean, when you got, just a ballpark number, obviously, $1 trillion worth of short bets still in the market. I mean, oh Lord, even if half of them is covered, we'll be at like 2,400 on the S&P 500. Because there's a lot of massive bets against the market. So this was a small slice of what can happen when they get squeezed. So that's what they did. They attacked it. All right? The cluster of where the majority were positioned. Majority were positioned for a pullback after yesterday's reversal candle. And let me zoom in. And you guys should see the same things on your screen. 1 second. Let's just look at this situation that's on the ground right now. So look what happened yesterday. We hit the upper end of the consolidation channel, and we did a complete inverted hammer, which, if the world was a perfect place, would have gone and touched 2028 right there. That's it's pretty clear. You hit it, you turn, and you just went straight down, because that's how it happens. This is a reversal hammer or inverted hammer, and these are hammers right there. A hammer reversal, an inverted hammer. It's bearish. Nothing crazy. It's bearish. So so where does it get contained? It would have been contained right here at around 2025 or something like that. Today, the market opened up lower, and it looked like, as I showed, that we were going to go and test this 2020 level. Well, the market doesn't do our bidding, right? It's not what we want. It's what it wants to do. So here we were on the stochastics. We were coming down. We were, we were just ready to kind of, come down, bounce off this level here. One of the things I did mention in our in the advanced coaching sessions on Monday, I believe I did one, yes. And I said one of the things I was getting enthused about was this selling, these two big sell candles, then the reversal on Tuesday, I'm sorry, on Monday. All this was getting this market into oversold territory that normally does not happen with these type of pullbacks. We were getting down to daily oversold, and we got down to daily oversold, which was almost similar, well, not quite, but almost similar to where we were back in early February when the market turned. We were at 1,800 at that time. But this type of hammering in the market, consistent hammering in between up days and this and that, and there were 2 days where we ended at the lows of the day, right? Today was Monday. So Friday, Monday, both sides we had an inverted hammer. And all these were looking like they were just coming down and that we were going to get this deep oversold condition. I said, that's exciting because you don't get daily deep oversold conditions that quick. Remember, the longer the time frame you're looking at, daily, for example, forget the weeklies for now. So the daily, and you're seeing your STOs or stochastics, people follow RSI. STOs are nothing but just a derivative of the RSI, right? It's the same thing. So getting this oversold where it's coming close to breaking 20, then you're telling yourself, hold on a minute here, this is good because now we can have a reflex bounce, which is going to be powerful. So that's what it looked like it was going to do this morning. And lo and behold, the oil news came out, and see you later. And this is what happened. So bottom line is that at this point, be prepared for anything. The normal logical move on a technical basis would be that we get up to 2080 and then hit some turbulence up here. But given what we are going through right now, right, within this consolidation channel, would it be a big surprise to anyone that we basically pull back in the channel again before we catapult higher? I wouldn't be surprised. I'm not surprised with anything that happens in the market these days. Yeah, it gets a little dizzying at times. I mean, it's happened to me. Imagine what happens to you guys. I try to keep my emotions in check as much as possible, and I fail sometimes. So a lot of you, you got a lot of work to do. You know that. And there's nothing wrong with it. So don't get swayed by every single price factor that you see on the screen. I keep on talking about this all the time. Price is sexy business. Price goes higher, like, wow, look at that, it's beautiful, I want to go date that stock. Well, guess what? Right when you start dating the stock, you get smacked, you get run over. So you always have to look at the internals. You have to look at many other aspects of what goes on. So this is the simplest way of looking at it. So on the daily charts, it looks like we are on our way to getting, this is nice. Turn, and looks like we're on our way to getting overbought. So once we hit, in a simplistic level, once we hit this 2100 level, or somewhere between 2090 and 2100, I think we're going to get a beautiful shorting opportunity based on what we see on the internals and what I see on just drawing the simple patterns. Daily, bingo. It's clear as daylight. So somebody says, no, I really want to know where the exact top is. Well, searching for a top, like I've said many times, is like searching for a bottom. Okay? It's like, oh, when is it coming? When is it coming? Oh my God, this market, this and that. And it just all of a sudden appears in the middle of the night. And unless you're a futures trader, you're screwed. Excuse my French. Because it just, we wake up and futures are down 20, futures are down 30. How many times have we seen that? How many times have we seen that? And if we are positioned wrong, oh boy, it's not a pretty feeling in the morning. Except those are the days, generally speaking, we tend to make the most money because I show all the inflection points, where we're going to bounce from, and whether and the market's down to 200 points off the bat. And this I've shown repeatedly, and many of you have participated in it. You made money that day. I like cheap things that move up in price. But at the same time, the difference is that what some people might think is expensive, I look at the technicals and I process the fundamentals. I look at the sentiment and I say, no, it can run higher. Some people might say, oh my God, 604 in Amazon. This thing is out of control. Amazon going to go to 650. The Amazon's high was $700. So that's one of the things that I do. As you know, I look to see the beaten down, distressed, fallen angels as much as I can. I like Netflix because I think it's a good bet where this thing stock can go to 116. Keep in mind that no one talks about the fact, I didn't see anyone on TV talk about it, that Netflix was up 5% today. Almost 5%. Apple was up 1.3%. Amazon was up $8. But I look at percentages. 1.3%. Google was up 6.5%. Did well with that too. Was up less than 1%. Priceline was a $33, $34 mover. I called it last week, if you remember. The 1280 calls went berserk. They were what, $4 or $5? They were 27 today. Or a little bit more than $4 or $5 at the time. But it was only up 2.56%. So when you look at one of the largest movers on my main screen, it just happens to be Netflix. Now, does that mean that Netflix is the best thing next to sliced bread? No, it simply means that looking at the charts, looking at the movement of money within it, a 5% move is something you have to take note of. We have to take note of. Aside from good old Chesapeake up 36%, and while some members in our group were trying to short that stock, I don't know why, I really didn't see any real 5% movers. Yes, there were few of them which were up like that. Anyway, so what I'm getting at is you have to be selective, and you have to pick and choose. Now, I don't care about LinkedIn. I don't use LinkedIn, but I think the stock has a fair shot to get to 120, and it's just going to happen. Believe me, it's going to happen, because the stock is basing. The internals are showing, and we're going to go through that. We'll look at a bunch of charts, and I think it's a good risk-reward ratio where you have a $100 floor and you have a $120 to $130 upside. Not too bad when you look at the risk-reward potential on what a stock can do. You don't always have to be in the hottest stock of the day, because those are the ones which burn you most of the times, because you're chasing it at the wrong time. So let's get back to the S&P here. So the S&P is very simple. So these are the levels we're watching. I posted this chart. I'll repost it again. And as you can clearly see, looks like we are out of this bull flag at this point. I wouldn't be surprised if we slip back into it. And if we slip back into it, it doesn't mean the end of the world. 2034, as we can see, 2035 is a very important level. Below that, it doesn't matter what stocks we own, they're just going to go whoop. You know that. There's no fundamental. It's a machine-driven, pump and dump. So good old Amazon up $10 will give back 12. It just happened the other day, right? Happened the day before. So at this point, that's what I think is going on. Now, looking at the daily, the internals are suggesting that we are going to basically get overbought. And do not forget what I've talked about for months and months, and from the beginning of my service back in on April 15th. It's going to be a second year anniversary this April 15th. I've always talked about the fact that don't mess with monthly options expiration. For some bizarre reason or whatever, I'm sure there's a lot of technical reasons, it is normally a bullish event. But before that bullish event, you will get one quick pullback, because remember the slingshot theory. In order for the slingshot to gather kinetic energy, you got to pull it back, right? You got to pull it back, and then it slings forward. Same thing with markets. Physical laws of nature, all right? So that pullback could be the 2020 level that it never met, because technically speaking, you should get to the bottom of the consolidation channel before you spring forward. But obviously it happened from midway. So that's it. So you just got to keep that in mind. Now, whether that comes tomorrow or whether it comes on Thursday, I don't know. But I think Friday is going to turn out to be a powerful day. But I warn, it could be the first part of Friday before they start withered down things. Options expiration. Fridays are the most difficult days to trade, even though we've made money on Fridays, on the lottos and things like that. Because Fridays, there's so much stuff going on. There's pinning the strikes. There's options expiration happening all across the board. They're holding down stocks to this, and it's just like a random. It's like a structured volatility, right? It's structured chaos. So just we'll have to be careful about that. But I think that at least the first part of the day is going to be positive. Now let's take a look at the real life version of the S&P 500 that's taking place behind us right now, and let me do this. Hide all the drawings. Bingo. So let's look at this very simplistically, okay? This is the actual E-minis in motion as we speak. This is the daily, looking fantastic. It's on its way to getting overbought. On this smaller move, watch, imagine this was Friday, this was yesterday. Which was yesterday, almost hitting the bottom of the floor. And I saw it kind of turning, not turning. I basically thought that it was going to slip a little bit lower, but if you minimize the box, you're going to see it was already at the bottom. But then it was sliding down before 10:30 a.m. this morning. So looking at this here, we broke out of this consolidation flag. As I predicted, my initial prediction was exactly correct. You can go, feel free to review my charts on that, and you could draw it like that. And now we're broken out. So let's look at what's going on here. So at this point, if you're looking at upper end of the Bollinger, if you want to look at it very simplistically, you don't have to be a rocket scientist to do this stuff. The upper end of the Bollinger is roughly 2100. That translates into 2110 or 2108 on the S&P 500. So I'm going to do this, 2075. I say we hit some major turbulence around 2075. So that's 14 points from here. Multiplied by 6, you're talking about 84 points or so on the Dow before we hit some turbulence. It's not going to be a clean slice break, in my humble opinion. I could be wrong, because this is a major point of supply. This is where we got to, and we started to stumble. However, remember one thing I've learned over the years. The more you bang against the floor or a wall, it breaks. And if this is going to be a triple hit up here, it's going to break higher. And that's going to be the surge up to this 2096 level or so, which is another 100 points, 120 points for the Dow. My opinion is that if it hits this wall, there will be mini turbulence, and then they're going to break out. And this is on the actual E-minis, which I've tracked 24/7 to get a direction of what's happening behind the markets. Right now, futures are up 5.5. So we're already moving, and you can see that in real time. We're already moving. Okay? So this brings us to my next point. What futures are doing at this stage of the evening, at 10:30 in the evening, Eastern Standard Time, 7:30 California time. It means nothing. It really doesn't. In the old days, you could actually surmise, like, okay, futures are doing this at this time of the evening, and then tomorrow we're going to open up. Because everything could be topsy-turvy by the time the European markets open, which should have a solid opening, but then there could be profit-taking. Always think outside the box. When things are moving up, somebody's going to take a profit. So that profit-taking could hit us when we open for business at 9:30. But, so I personally don't like when futures move up too big, too fast, even though I still have limited long positions running, so it'll be nice to see those move up. So at this point, 2075, upper end of the thing is 2095. So you can see this clearly on your screen too. You can always do that, the rising wedge, take the line, draw it. You can pick a point, try to match as many points as you can. So this is good enough. 1, 2, 3. Okay. So you can see they all meet there. And that's, I think, where they wants to go. Now the JP Morgan numbers, which I think are going to be good, or even if they dip, I think they're going to buy it, but who knows, right? I have a bunch of JP Morgan calls. I have some common. I don't particularly care about the company, but I think that's going to, if the financials trigger up because of JP Morgan, we're going to get to 2075 and 2095 like almost immediately, because the financials are such a big part of the S&P 500. I'm sure you guys understand that. So there we are with that. Once we get overbought at this level, don't try to be like, don't get all giddy and stuff, all right? Don't be like, oh, this is the start of the next bull market. It's all garbage, all right? Because this is a market moving within a range. It is not, honestly speaking, I know you might hear this. I don't know if you heard it. This is neither a bull nor a bear. How about that? It's a market that's just slowly moving up, grinding higher in between corrections and nice fat corrections and complete absolute terror like we saw here. It's just a market which is just kind of retracing back what it lost back from last May. So how about this forecast? We topped on May 5th, 2014. I'm sorry, 15. I think May 5th. So how about we top on May 5th, 2016? I wouldn't be surprised if they, because markets have a weird way of doing this one-year calendar stuff. Okay? So we could be at around the first week of May. We are reaching a pretty substantial top in the market. Maybe a little overshoot. So if you want that big short, the one that everyone's waiting for, you know, ones that won't name any names, won't stock to it, some guys who are just so dogmatically short, it's like, whoa, man, you give me a headache. I mean, they're just like, the world's ending. Well, a nice medium-sized short where the bulls get baked is probably coming in May. But it's going to be fast and furious because nothing is that easy these days. They make it fast. You don't react fast enough, then they'll move up against you hard. There's a lot of money on the sidelines, a lot. And this is not central bank money. This is actual money by fund managers. Hedge funds are net short. The retail money is sitting on the sidelines in the money market accounts. And they will be forced to come back to the market at one point. There's no question about it. So, so that's my prediction, okay, on that. Now, let's take a look at a couple of other charts. Let's skim through a bunch of things here.
Hey, Frank, this is Corey. Can I ask you a question?
Yeah, go ahead.
When you think that May something 5th might be the top, I know this is just a huge prediction, but let's say the market does have a pullback. Would you suspect it's going to go back down to 1800 or just no thoughts on that?
My gut tells me that to go back to 1800, you got to have this real cataclysmic event. You know what I'm saying? And that was a good point that you brought out, because I was thinking about the other day that what, you know, in order for these type of, because it's a lottery ticket, right? Think about it. If you're short and the market goes back to 1800 like it did here this fast, right? From 2075 to 1800. I mean, man, that's like winning the lottery ticket. You just stay short and you're like, that's it. I'm buying 100 puts at 20 bucks. And I'm just exaggerating. And then I'm going to make $2 million. Well, the market never makes it that easy. So in my opinion, a repeat, let's look back at history here. Let's look at the weeklies, okay? So when you see the weeklies, there were two major drops of this magnitude, three major drops of this magnitude, to be honest with you. Well, this was a small one. So let's take this one into account. 1, 2, 3. Chances of a fourth one happening this fast, this quick, in my opinion, is somewhat remote. Will it come? Yes, I think it comes from possibly these levels or slightly higher levels, excuse me, in October, right before the elections. October is always a very turbulent month. We know that, right? And generally, the corrections come in August. And October is a turbulent month, and then it surprises to the upside. So my opinion is, and it's a very good question, Corey, that will the market immediately hit these levels in May and then get to 18? I don't think so. Now, look, anything can happen. We could have a cataclysmic blowout in one of the world economies. Greece completely falls apart, takes a couple of German banks down, affects us. Anything can happen. But just looking at it from a pattern symmetry standpoint, no, I don't think so. Now, can we lose half the value and get down to 1950, what we call a 50% Fibonacci retracement? Absolutely. No question about it. We could easily come down to 1950. We could come back and test it on the weekly. If you notice, we can come back and test 1990. So those are, you know, good. But to physically go down here, I think it's a low probability movement, maybe 20% probability. I don't know, 10%. But if it does get down here, remember the theory that I follow, third time, the floor gets weaker. At that point, there could be a real move down. So again, if the short base completely gets decimated because we make a we make a move up on the weekly, if you notice, the upper Bollinger is at 2160. 2160, that's 100 points from here. So 100 times 7, that's a 700-point move on the Dow, which brings us to 18,400 or so. So this move, if it happens and it gets to the upper end of the Bollinger, you're at 2160. Now, is it possible that from 2160, and that's why I like Bollinger Bands, because they kind of make it life easier for me. They give me a range of where the market can travel in. So if you look at the weekly Bollingers, we have just, the weekly Bollingers are 2160 and 1802. I mean, talk about a wide range. Okay, so for this to go from here all the way down here, well, we better be on the gravy train if that happens. But here is how you can tell if something like that is going to happen. So I'm just going to show you a simple trick that I've seen over the years, and it's simply by tracking the 34 and the 50-day moving averages. Yes, you can look at the 200, you can look at this and look at that, but this one works very well. It's got a high level of success. So let me just show you this, okay? Real simple. Let's get this out of here. Let's look at the daily. So all you got to do is you got to start tracking the 50 and the 34. As long as they're trending higher, the uptrend is on. It's really as simple as that. Now the uptrend doesn't break till we have these crossovers, okay? Till we have these crossovers, and even and they start to curl down. This was a big move down. There's no question about it. This was a good solid 500 points, 600 points on the Dow. This move here. But the uptrend continued. And anytime you break a major trend line, it tends to go back and retest that. Multiple failures of the 50 and the 34 is what is the first determination that something is really wrong in the picture. Now here is the problem. The machines completely confuse the heck out of us, because here we went well above the 50 and the 34, but if you were looking at the directional bias on the trend lines, you could see that they were pointing down. So despite this false move up at the end of December, it was and again, there's a level of luck that's involved. But what I'm telling you is that if you start to see this trend line sloping down, and then you have a crossover of the 34 and the 50, and when you start to see that happen, then you got to go short and you got to stay short. In other words, you short every rally. If there is multiple retests of the 50 and the 34 and a failure, that's the first sign that something is going wrong. Now, what's going right here is we could, as these lines keep on rising, you could have multiple retests of the 50 and the 34, but the uptrend is intact. Is that clear to everyone?
Yes, sir.
Absolutely.
Yeah, and it's really as simple as that. Look, I've always said this, and I believe me, I'm not bullshitting anyone. I'm self-taught.
I have a question, please.
Yeah, and anyone can learn this. Yeah, go ahead, Shawnee.
Yes, sir. You said that anytime you have a breakout from a bear flag, they always fail first. Breakouts always fail first.
I mean, out of a bear flag, but there is no bear flag here. What bear flag are you looking at?
I'm sorry, the consolidation channel.
Consolidation channel. There is not necessarily always a retest, but a retest is good. If it pulls back here from 2060 down to 2045, retests this and moves from here, all it does, it gives it more ammo, more fuel to move higher. But it is not mandatory that it will immediately come back and retest the upper end of this consolidation line.
Yes, I agree with that. I was just wondering, but most times they do tend to fail, correct? Not always, but most times.
Sometimes it does. Yeah, absolutely, absolutely. And those and those pullbacks are very quick, because all the shorts are so nervous, right? So anytime there's a pullback, they're like, oh my God, I got to cover right now. So I just think that on a shorter term basis, that's what we're going to go into next, what we need to be prepared for over the next 24 to 48 hours. This is a bigger, longer term picture, right? Longer term nowadays, long term means 3 days. I mean, for God's sakes, because of the machine. So the point is that this is more of a swing picture, like, okay, we're going to go up here, maybe hit some turbulence, like I said, move down here. This could happen. I repeat again, okay? This could happen, just like that, before we move higher. All right? So we could easily give back 200-300 points as long as we keep an eye on the uptrending 50 and the 34, which will continuously keep on acting as support. So as long as those keep on acting as support, don't be a really dogmatic swing short bias. Just remember that. Don't stay like that, because you're going to wake up the next morning and they're going to finish you off. So as long as these lines are creeping higher, that's all. Now, re-engagement with these lines as it moves further away from, as the prices move further away from the moving average, we know what it is. It's called standard deviation. But if you look at the standard deviation from where the markets are right now and the moving averages, it's not too wide. When you get a standard deviation of this magnitude, like we were, like the distance was pretty wide, right? Standard deviation maybe 1.5 or so. Look what happened. A consolidation. It brought us closer to the moving averages, and now we're moving away from it again. So if we get too overstretched, you're going to get a quick pullback to get closer to the moving averages, because moving averages are kind of the pathway or the highways, like I like to call it, that the prices need to move along. When you move away from it too much, whether on the downside, this was a standard deviation of almost -9. I've talked about it before. That's unheard of. So whoever the bozos were who were telling me, okay, on StockTwits and some of the people, that this was the end of the world, we're going to go to 1600 and this and that, and it certainly looked like that in the middle of the storm. Well, they have no idea about basic machine-driven technical analysis. Anytime you fall apart that hard, that fast, you are going to get a retracement bounce that's going to try to kiss the backside of those moving averages. Okay, like it did here, Crashed, got back, kissed it, failed, came down again, created a double bottom. Nothing is more powerful than a double bottom. Okay, that's it. It's almost simple, but when it's happening, it's tough. Like they say, if we can sit there and strategize about battle plans, but we're in the middle of the firefight, it gets a little bit unnerving. We know that. Standard procedure. We're human. So let's take a look at some hourly charts here, because that's what that's important to us. So this hourly chart is, as you can see, there's a monster short squeeze, right? I don't need to tell anyone this. So this pattern, if you look at pattern symmetry, this is what's going on here. We are in a massively volatile environment. Not the first time, but we're going through it again now. So the upper end of the volatility ends around 2070. At that point, we hit some major turbulence, and that turbulence could bring us down again. Don't be surprised, down here again. So the trading band that we're moving in on the E-minis, for example, is 2030 to 2070. 2030 to 2070. Good old 40 handles, which is roughly about 240 Dow points. So 240 Dow points can mean a lot for individual stocks. We know that. The Dow could be down 100 points, and some of the trading stocks are down like $15, $20, $8, $9, and it's like, oh my God, what's going on? But honestly speaking, for the machines, it doesn't matter. They're moving between a trading range, and this is the trading range that we are moving in right now. Period. This is the trading range we're moving in right now. Now, let's take some realistic, view on what's going on with the thing. Today, there was all day buying, massive squeeze, all that stuff. I know I watch volume very carefully, and you guys should do that too, because the volume tells you a story on what's really going on. There was a big this volume candle. That's a pure short covering spike. What time did it happen? 10 o'clock when the Saudis, well, nobody actually officially announced, but Interfax of Russia announced that, okay, maybe it's happening. Some insider said that, whatever. Maybe it was a big fat rumor for somebody to make some billions of dollars right off the bat, right? Happens in the market all the time. So saying all that, look where we are. And this is something I follow very closely, and I try to show you guys all the time. And do that. It's pretty easy. We're severely overbought. We can stay overbought for a couple of hours, but I can assure you that sometime between tomorrow and Thursday, we are going to get a reset. Now, whether that reset happens in the middle of the night, most probably it's going to happen in the middle of the day. And this reset, when it happens, is your next real buying opportunity. That reset could bring us down from 2060 or so that we're trading in right now on the E-minis down to test, like Shani just correctly pointed out, the back test, the upper end of this channel. Backtesting channel standard procedure. It happens more often than not, as Shani correctly pointed out. And I've shown that clearly many times. So backtesting this means we're going to drop about 20 S&P points. So 20 S&P points is roughly what? 120 points. That could be the quick chance for the shorts to exit with some level of dignity. All right. Now, once it happens here, it should bounce if the market is on a trend to go up towards this 2075, 2080 level that I showed before. Now, for that to happen, this reset has to happen. Now, resets can happen very quickly. They don't necessarily have to have a number of points that it needs to come down here. Just remember that. I've seen resets happen on 50-point move on the Dow, and sometimes I've seen it happen on 200-point pullbacks on the Dow. So it's not an exact number correlation like, oh, the Dow's going to be down 50 points and we're going to reset down here on the hourly charts. No. I hope everyone understands what I just said. It doesn't have to be a 300-point move in order to reset. It can be a sharp, swift 50-point move on heavy volume and we get reset. But this reset is coming. Sometimes resets get truncated. In other words, they're down here and then they go, oh, yeah, we're like, okay, some people like heavily shorting and then bang, it goes up again. Anything can happen. The danger to the shorts are, or the heavy shorts are, that we have options, monthly options expiration on Friday, which is in a high percentage basis, a bullish event. I don't make it up. That's what I've seen over and over again. I've seen Apple calls go from 40 cents to $4 just on a Friday morning. Not to mention so many other of these lottos, okay? There's no guarantee, but I'm just saying you that it's happened. Now, if we fall back into the channel below these moving averages again, make these your friend, the 30 and the 54, the red being 50 and the orange being 34. Put whatever colors you want. If it falls below that, then we start to get a little bit jiggy on the downside. If it falls below that, the next level of engagement is the Bollingers. Always have Bollingers on your screens. Make them your friend too, all right? They're just trading bands. That's what Bollingers are. So that's going to be 2035. We break 2035. Then we are looking at that 2020, which we never got today, or the 2010, which completes, in my opinion, the full consolidation. And at 2010, screaming buy, at least based on what we're seeing in front of us. At 2010, we can basically ride the wave another 200 points and possibly a real burst out up towards this level. So all these scenarios are there. Which one's going to exactly play out at what time? I don't know. But what I'm saying, the probability of the market getting up towards 2070, 2080 is highly likely by Friday. However, if it breaks below these channels, inside the channel, then it's back to the channel game again. And this is an hourly chart. But what I do know, based on my past experiences, and just as recently as yesterday, that when you get overbought, you have to get oversold. When you get overbought, you have to get oversold. Now, I showed them extremely clearly, and I think very accurately on my high frequency, on the algo HFT charts. And I'm sure you guys are not by now starting to get the hang of it. And just to give you an idea, I showed a chart which, if some of you should remember, which showed the whole dragon bullish formation in big white arrows. And I was kidding around with Scotty that Scotty's like, oh yeah, it's just, remember Scotty, we were doing that? I'm looking for that chart on my Twitter feed. By the way, I'm getting version 2 of my website coming up shortly. Trying to get this done so that you guys will have full access to these charts directly when you click on the website. So you don't have to scroll through on the Twitter feeds. I do apologize for the interim development that's going on. I'm trying to look for it here. Bear with me. It basically showed big fat white arrows. Oh, here it is. This was one that I showed. and it said dragon bullish. You guys, any of you remember what I'm talking about? It said dragon bullish, and it showed the S&P, you know, on a W formation.
Yes, I remember.
You remember that one? That was a kind of a loud chart, you know. And I am looking for it, scrolling down, and hopefully I'll hit it. Bear with me 1 second. It'll be worth taking a look at it. Okay. Oh, came across something else which I'll show in the meantime. So take a look at this. All right. This was a consolidation channel that I kept on showing. This was a consolidation channel that I kept on showing, and this was on the Nasdaq, but I kept on showing that on many times, as well as writing on it, consolidation channel, and that's exactly what's playing out right now. One second. Oh, here we go. Okay, so right there. Upper end of the channel seems to be 2060. That's where we keep on heading, you know, headbutting. And now we have broken out. Have we broken out over that? No, we haven't broken out over that. These are the E-minis. We're still stuck there. But it's funny. It says, you know, right below that, that's exactly where we're stuck. You know, we're up about 4 points on the E-minis, and we're still stuck within this range here. This is another thing that I noticed. I look at volume. I mentioned that I saw volume at the end of the day, despite the fact that the market pulled back. The overall day was a green day on the volume side. So I showed that, you know, green equals buying. I mean, just, you know, kindergarten stuff. So always follow. I mean, not necessarily follow, but do study every one of my charts that I put out there. Oh, here it is. Okay, so I put this out on April 8th. Wow, that seems like ages ago. April 8th was what? Friday? Was Friday. So I put this out on Friday, on April 8th, and I said, this is a strong possibility. These candles, and this is the beauty about this particular program. When you see an algo pump and dump, yeah, you can see that on your screen, you know, candles turning green. But these ones literally move at light speed. So it gives you an idea about when I say heavy algo activity in the markets. Yes, I'm looking at some other stuff, the proprietary stuff that I look at, but I'm also looking at this visual picture. And by looking at this, and I've trained my eyes to look at this for the last couple of years, I can tell pretty much when they're coming in and going. Now, this stuff helps in the sense that these are the slow stochastics, these are the fast stochastics. The slow stochastics take time to build. They're the swing trade type of things, and the fast stochastics move really fast. This is an hourly chart. So I called it a market structure low dragon bullish. Okay. Fancy technical terms. Simply looking at this, this is exactly how the market played out. Now, in between, the market went down, closed this gap, and basically came down to, I'm looking at my other screen here. We came down to around here, 2040. Okay, we came down to 2040. But this structure held. And my gut tells me that's pretty much what's going to happen. Here's 2075, and that's where they want to finish. You know, they want to take it. And this formation is very, you know, it's intact. Now, what we did today, just so you know, and it's on the screen. We actually went right here. We went right here, and then we created a doji. So let me show you that same chart. So bear with me 1 second. And I showed that inverted candle, or what we call a naked bar spinning top, all this nice, cute names. So this is what it did, right? So that's a naked bar. And it just happened to be right where the gap is. It's funny how these things happen, right? Look where the gap is, right there. So there's your naked bar. So we had this naked bar today, spinning top, reversal candle, whatever you call it, but it created a doji. So if you create a doji, it can do two things. It can continue higher up to it's at 2068, and then maybe, and then real move up, go straight to straight to 2075, completes this whole pattern. And believe me, that's volatility patterns. But it's multiple. That's why they call it a market structure low. And then this move. So what I'm betting on to get out of my puts with at least some semblance of that portion of my portfolio which is in the puts, right? With at least keeping some taking out some dollars at least and not a complete waste. I would say that this particular pattern helps, because what that's telling me that late day sellers, which I showed too, took out a big chunk of the money. More than 300,000 contracts were sold on the E-minis in the last 15 minutes, that there could be a little pullback. Now that pullback, can it be like this? Sure it can. JP Morgan craps the bed. It can. No question about it. But then it can still go like this. So what I'm getting at is, realistically speaking, it should just, give back maybe 100 points or so, or 80 points. Remember, 50% retracement. So we went up 165 points at the close. We can give back 50% of that, because it happens as standard procedure. 50% Fibonacci retracements have happened almost 90% of the time on any time there's a big move up. Now, here's something else you guys should know, and maybe some of you know better than I do, is anytime you have a big move up, the market makers need to reset, because they need to get their money back. You don't think that people were taken by complete shock, a lot of the hedge funds, at what happened at 10:30 a.m.? It wasn't just me and others who played the S&P puts. There's some serious players who got hurt today, and they want their money back. And they want their money back. It does, they'll somehow finagle the market for it to come down a bit, so that they can get their money back. It happens all the time. That's also part of the resets. Just remember that. So looking at this picture here, this was the point of maximum pain right here at 10:30 or so. Okay, so is it possible that we do this? So this was the point. Is it possible that we do this? Absolutely. Absolutely, it's possible. That also coincide with the 2035 Bollinger on the E-minis. Absolutely possible. By that time, if this happens, for whatever reason, you're going to get that nice reset and high probability move that it's going to bounce from there. And if it doesn't bounce from there and this breaks, we know where we're going. And that's a great short. If we can get 30 points on a short, we've done this before. It's big stuff. So that's it. Now, let me skim through a few other charts so we don't spend the whole night on GoToMeeting without any nice drinks or this virtual stuff going on. And we all need our beauty sleep. So let's take a look at a few other platforms, if you want to look at it that way. So one of the platforms, come on. Some bigger picture. So you're looking at the Dow Jones here, and here is something interesting. If you look at the Dow here, okay, this is not good. All right. So the Dow, even though it had a nice this was that gap up and holding it up there after 10:30. If you want to look at it from a standpoint of this is still on a downtrend. Nothing tells me that this is about to curl up. This is kind of in purgatory. It's like hanging midway. So a full reset on the Dow would mean that this needs to come down here, and then you get that big move. Love buying things on deep oversold levels. So looking at this here, yes, it's a consolidation channel. Yes, it broke out, but this hasn't satisfied the requirement that's needed for a real tradable bounce. In other words, the Dow could fall 400 points, kiss the uptrending 34-day moving average somewhere around 17,000, 1,300, and then that's a buyable move, in my opinion. And even if it kisses the 50-day moving average at 17,000, that's 700 points below here. That's 100 S&P points. It's nothing to really fear, because as long as they're uptrending, that itself becomes another huge buying opportunity. But just by doing what it did today, didn't change the internals. In other words, it's still downward sloping on the daily. So there is a fair chance that we get a sizable move down before the month ends, and then we move up, or it can happen as early as Thursday. Okay, so just passing it on to you. These are all probabilities, because look at this. Now, every platform will look a little bit different because the parameters of the stochastics are a little bit different. This is a slow stow. If this had completely curled up, I'll tell you a different story. All right? Looking at the Kapok curve, which is basically a more longer term swing type of picture, the Kapok is also trending down. So that means we are going to have a pullback. Okay, so don't get, so keep things tight to your vest. Don't be thinking out there, oh, throw out all this big money overnight and then come back in and get completely ambushed. Let's take a look at the NASDAQ. The NASDAQ, on the other hand, on the daily is starting to look a lot better because this is actually turned, and there's a good possibility that it moves higher off this elevated 80 RSI level. And looking at this chart pattern here, it's starting to look pretty good. This is actually a nice, this is a nice cup, if you want to look at it this way, this is actually a large cup and handle. Consolidation and the breakout. Why do you think that might happen? And the NASDAQ gets back to 5,000. I'll put money down the NASDAQ gets back to 5,000 because one of these bozos, Amazon or Priceline or Netflix, is going to blow the numbers sky high. And I'm not even talking about Apple because Apple's the same old story. Okay? Apple, they probably move it up $3 and move it down $3 and keep it flat on earnings. Honestly. I mean, you just don't know. I mean, it's just way too overowned, and it's different. But one of these companies, Amazon and this type of power companies, which are actually starting to make real money, they're gonna blow it up, and the Nasdaq will get to 5,000. Let's take a look at the Russell 2000. Very constructive chart. Very constructive. Said it before, and I'm sticking to my guns on this one. Okay. This is turning out to be a nice handle. On the upper end, you're looking at 1134. I said that 2 weeks ago. 1134, you got 30 points on this thing here. Play the RUTs, play the RWM. Okay, now that oil's found the real footing, it certainly has, no question about it, then you are going to see, look what the oil companies did. All these little, puny little companies just went sky high. So this is obviously good for the U.S. small cap growth, and this one, I like a lot. You can look at that here. IWM, the same story, same pattern. Looking at it, this is actually a bull flag. Let me take this out. Not to confuse anyone, move this line down. Watch this. It's going to go like this. Even if it falls here, another red candle the next day, which I talk about a lot in my sessions, and it sometimes happens pretty much the next day. It doesn't matter as long as these lines are up, trending up, and this consolidation thing does not completely fall apart. If it just touches the bottom end of this and then moves from here, it's all okay. That's the way things work. Let's take a look at S&P. This is the doji I was talking about, end of the day. We're overbought. This is another indicator I used to use. Okay, I still use it. The upper, I put a Bollinger Band over the MACD histograms. So what it does is when it's pushing up against the upper Bollinger, that means you're kind of stretched. You're getting stretched. This is on an hourly basis, obviously. So this doji is telling me that we could have a nice little retest, reset, and that reset would, we could give back anywhere from 50 to 100 points real fast. They won't make it easy, but it can happen. Because that's, and it hit the upper Bollinger and all that stuff, and we got overbought real fast. This is very positive. The vortex indicator, this is a swing directional chart. You can use that yourself. The vortex, the VI is moving up real fast, the green line. That's a good thing. The red line crossed over and moving down. That's a good thing for the bulls. Taking a look at the stochastics, it's overbought, but it's not there yet. It's getting there. So a reset would be good, but this is still a pretty powerful formation. I don't want to get into it too much. SPYs. The SPYs, this is something I've shown before, and I'm showing it again. This is the hourly chart because that's what we're concerned with right now. This was the consolidation channel that I talked about. This is another consolidation channel. Now it's breaking higher. So where can the SPY go? I showed it in the form of the S&P. The SPY basically can get up somewhere around 207 plus. IBB chart is intact. Okay, it's intact. However, on the daily, we're starting to see some levels of exhaustion, and that is something that I'll be monitoring very closely, and that is this. The internals are starting to get a little bit tired because they're overbought. So I'll be watching this very carefully. So we need to get some slew of powerful FDA approvals, earnings, mergers and acquisition, things, M&As, things that really spark the fire under the biotech sector. However, this is still a double bottom, cup and handle, and that's pretty much what it is right now. Yesterday, it was still a consolidation channel when everyone was freaking out. Okay, so if this thing is a consolidation triangle, yes, it can come down a little bit more. I don't like necessarily the angle of how this crossover is happening. This needs to be more severe. In other words, the crossover has to happen faster and quicker, like this. Whichever the case, the consolidation triangle should, consolidation, the cup and handle needs to break out. There's a big fat gap here around 315, and I think we get there. However, if we break below these moving averages, then we are in trouble. And the biotech sector is heavily volatile. We know that, right? So, you just got to do, you got to keep an eye on it. Here is something interesting I'll show you, which I've shown very clearly to a lot of other people many times, which is the 10-year bond. Very simple. When the 10-year bond yield is going higher, that means money's coming out of the fixed income market or the safe havens into the stock market. That's the reason why the bond yield today, the 10-year bond yield, was up to 1.78% from a low of 1.65% as 1.67% as recently as yesterday. All you got to do is move the decimal point one step to the left. One to the left, okay? This is not the bond price. This is the bond yield, which moves inverse correlation with bond prices. I'm sure all of you know that by now. Okay, so very simple. If this was a chart of a stock, this is a dragon bullish formation in the making. If bond yields are going to move up towards this level here, which it normally finds a major resistance around 2%, a lot of money is going to move from the bond market into the stock market, what we call risk on. Okay, is that clear with everyone?
I understand it clearly now.
Exactly. Risk on is risk on, okay? So you can see there's a lot of competing factors between overbought, oversold, but the big macro factors that drive the market are getting ready for a real blast up. That's what I'm getting at, all right? So whether we like something moving up or too much, oh my God, it's overvalued, it's all crap, it's all smoke and mirrors, who cares? The macro factors are driving the markets higher. So as we clearly see here, this is a powerful driver of the markets, the 10-year government bond. The 10-year government bond right now is in a W dragon bullish formation, as we can see. However, it's highly volatile. These candles which moved up like this can very easily move down the next day. Okay, however, internals are dictating that it's starting to move up. Bond yields get back over the 50 and the 34 line. Let's say move back towards 1.9% or so, let's say. A lot of money, billions of dollars, will flow out of the bond market. That's just the way it happens. They got to find a place to park. They don't go into money markets. Why would you go from a money market, from a fixed income government bond? Government bond is the safest asset in the world. Okay, the U.S. government bond. You go into risk assets. So you go into dividend-paying stocks. You go into this. Maybe they don't go into Regeneron, but, they buy stocks, and that drives the market higher. So that is another factor that's driving the market, loud and clear. Let's take a look at something which I've showcased lately, and I've showcased before, which is the Japanese yen, something called the carry trade. Want to know exact definition of the carry trade? Then just Google it. Okay, it's basically borrowing the yen and using that to convert into US dollars and trading the markets like a real big fat gambler. Okay, that's what's known as a carry trade. It's global margin, loan sharking, if you want to look at it that way. So when the Japanese yen is strong against the US dollar, i.e. the Japanese, this is the actual ratio. So it's right now, it's climbing. You can see that, right? Not climbing much, but it's climbing. Every little tick matters. When the Japanese yen was breaking down on Monday, today's Tuesday, right? Yeah. Monday, we were down towards 1.7.62. Not a good thing. I put a chart up there saying if we break 1.108, it's not a good thing. Well, that's exactly what happened. This is the carry trade. So if we keep on creeping higher, let's say that it looks like a double bottom, and let's say we keep on creeping higher to the breakdown level of 109, 1010, because this was the real breakdown, then the markets will find another leg to move up. Okay, markets will find another leg to move up. Why? This is the way it works. When the yen's climbing higher, that means you're buying more yen versus the US dollar. Is that clear with everyone?
So far.
Okay, when they repeat again, because it's a little tricky, and it's like a little riddle in the head. So figure this out. When the yen's moving higher, that means for every $1 US, every $1, you can buy 110 yen. Get it?
Yes.
When the yen's at 107, that means for every $1, you're buying lesser amount of yen. So from an export standpoint, if the yen's very strong, it hurts their economy because what is Japan? Primarily an export-driven economy, yes?
Oh, got it. Okay, okay.
Yeah, so you get it? So if their goods are priced too high, then the overseas global economy will buy slightly less of that because they have to pay more for it. And that's the whole basis of currency devaluation. All right? When the yen gets stronger, they're not devaluating their currency. They're actually they're strengthening their currency. I mean, this is the yen against the US dollar, okay? So they want a weaker yen in order to keep on stimulating their economy. And that's the basis of all currency wars around the world. That's not the day's topic. So this is key. So as long as, let's just keep it simple. If the yen keeps on moving higher against the US, it gets weaker as it moves higher because for every dollar, you're buying more yen. Okay, so if you're buying more yen with every dollar, it's a good thing. That means risk on, and that's good for the markets. So we watch, now that seems to be the flavor du jour for every bond fund guy and credit guy out there because now they're watching the yen like a hawk. So yen's moving higher, so market trend is up. So these are the big macro factors in a nutshell that drive the market behind the scenes that most stock traders don't have a clue about, and there's nothing wrong with that. You don't need to be a rocket scientist to be trade. So go ahead. I'll take a few questions.
Hey, Clue, could I ask you one on that bond one that you had just a second ago?
Sure, Corey. What's that? The 10-year bond. That's the basis for setting all consumer rates that's out in the U.S., just so you know. Most of it. Sorry, PNX.
My question was, I thought the higher that number goes, that you had, the more that money comes out of the stock market, right? Because people are going to go more in the bonds.
Just the opposite, okay? Because what happens is that the yield gets to a certain point. Let's say the yield goes to 1.6%, right? This is the best way you can remember it. At the low of it, which was last Friday, okay? When the markets were croaking, we were down to this is actually 1 decimal point to the left. It's 1.69%. You with me on this?
Yes, yes, yes.
Okay, so at that point, the market had dropped to a level where the yield on the S&P 500, from what I last saw, was somewhere around 2.1% or somewhere around that. That's the actual dividend yield of the overall market. Okay. So if you were the big money, the real global money, are they going to sit in something at 1.69%, given all circumstances staying equal, or are they willing to take a 30% higher rate, because that's what it is? It's actually 30% higher, okay, from 1.7 to 2.1, or move into this? They at that point migrate towards the higher yield. Now, if the yield keeps on going higher and hits around, let's say 3%, or even 2%, at that point the tide turns. The S&P yield at that point goes to about 1.9% or so, okay, and this one goes to 2%, right? So at that point, where do you think money is going to flow?
it's going to go in the bond market, right?
That's right. That's right.
Yeah, so
if it goes to 3%, so what you're saying is correct in a certain way, is at a certain inflection point, the bond market gets very attractive. But it doesn't.
So as the yields go higher, the more the stock market falls, and the more the bond market picks up.
Well, as the yields go higher, money's coming out of the 10-year government bond market into the stock market. So the stock market is actually, if I may call stock market in, I put like ST, the stock market is actually going higher as money's coming out of the bond market, entering the stock market. But at a certain point, it's all about supply and demand. Okay? At a certain point, bonds get attractive, and that's mostly above the 2-3% range. Now, there's a caveat. The caveat is when there is global uncertainty, wars, terrorist events, all kinds of mini crises that happen around the way, money immediately flows into the bond market, and on those particular days when the stock market is down 200-300 points because of a global situation, you actually see the bond yields fall lower. Because money, remember, bond prices and yields are inversely correlated. You have to get that right through your head, right?
Right.
Prices going up, yields going down. Okay? Supply and demand. More people want it, so the yields are coming down. When less people want it, then obviously the yields have to stay attractive. So bottom line is simple terms, keeping it real simple. When at a certain point, it becomes unproductive. It's a law of diminishing returns, like QE. It doesn't work anymore. So the point is that at this point, bond yields moving higher also shows that there is a feeling of growth in the U.S. economy, that inflation's coming back a little bit. So that's another reason bond yields go higher. So low bond yields are not good. Low bond yields are bad because it shows we are falling into a recession. You got it?
Yep.
In recessionary economies, bond yields are almost 1% or lower. And that's terrible. Bond yields need to be a little bit higher because there's inflation expectations. Now with oil rising and stuff, inflation expectations are going higher. So that's the answer. Okay, I'll answer one or two other questions and we're going to wrap up because it's 11:15. So this is what I say when I do my coaching session stuff. I did the free webinar today to benefit everyone, but believe me, they run way ahead of time. I think we probably started around 8:45. All right. So, but I know this helps everyone, and so when they're relating to my charts, they're going to talk to you guys a little bit more. I'll tell you that. Okay. So that's why I do these type of things. Any other quick question that I can answer?
Not for me, but thank you so much for your time, and I enjoy every lesson.
Thank you. I appreciate that, Shani. All right, guys. So we'll engage tomorrow. Thank you for listening. I'll put this up on the thing, and only thing I ask from you all, okay? Very simple. Get referrals. We're growing nicely. We have a new member here, Roland. Rick Randall is a new member from the last 2 months or so. And anyone who's missed part of this session, please feel free to play it. Once I upload it in the next hour or so, it's going to be on the YouTube channel, and I look forward to working with any of you individually if you want, and God bless you all, okay? We're in a great place, and there's a lot of risk out there, but we try to manage it as much as possible. And like I said, good or bad, we're moving forward nicely. Thank you for listening, and good night.
Thank you for your help.